Traditional retirement planning assumes you'll work for 40 years to retire at 65, but cryptocurrency offers the potential to accelerate that timeline significantly if approached systematically. While most people treat crypto as speculation, professional investors use it as a powerful wealth building tool for long term financial freedom. In this comprehensive guide, I'll show you how to build a crypto retirement portfolio that could potentially replace traditional retirement accounts, achieve financial independence years earlier, and create generational wealth through strategic cryptocurrency investing. Before diving into specific strategies, let's understand how cryptocurrency fits into modern retirement planning and why it might be superior to traditional approaches. Traditional retirement model limitations. The conventional retirement system has significant disadvantages. Time requirements, 40 plus years of working to retire comfortably. Inflation, erosion, fixed income investments lose purchasing power over time. Limited growth, average 7 to 10% annual returns in traditional markets. Age restrictions, penalties for accessing funds before 59.5 years old, government dependency. Social security and policy changes affect outcomes. Crypto retirement advantages. Cryptocurrency offers unique benefits for long-term wealth building, higher growth potential. Historical returns significantly exceed traditional markets. 24/7 accessibility. No age restrictions or withdrawal penalties. Inflation hedge, fixed supply assets like Bitcoin protect against currency debasement. Global portability, assets not tied to any single country or system. Innovation exposure, participation in technological revolution creating new wealth. The FIRE movement and crypto, financial independence, retire early principles enhanced by crypto. Accelerated savings, higher returns can reduce time to financial independence. Location, independence. Crypto enables geographic arbitrage and remote income. Passive income, staking and DeFi yields provide ongoing income streams. Asset portability. Digital assets travel anywhere without restrictions. Risk considerations. Honest assessment of crypto retirement. Risks. Volatility. Short-term price swings. Can be extreme regulatory changes. Government policies could affect crypto adoption. Technology risk. Early stage technology with potential for disruption. Correlation risk. Crypto markets can move together during stress. User error. Self-custody requires education and discipline. Hybrid approach. Recommendation. Balanced approach combining crypto with traditional investments. Crypto allocation. 10-30% of total retirement portfolio. Traditional base. 70-90% in stocks, bonds, real estate for stability. Risk management. Appropriate diversification across asset classes. Gradual implementation. Start small and increase allocation over time. Creating a retirement-focused crypto portfolio requires different thinking than trading or speculation. Core holdings, 60-80% of crypto allocation. Bitcoin, 40-60% of crypto portfolio. The foundation of any long-term crypto portfolio. Digital gold, store of value with limited supply, institutional adoption, growing acceptance by corporations and governments. Network effects, strongest brand recognition and adoption risk profile, lowest volatility among major cryptocurrencies. Long-term thesis, digital reserve asset for the internet age. Ethereum, 20-30% of crypto portfolio, the infrastructure layer of decentralized finance, smart contract platform, enables most DeFi and Web3 applications. Economic activity, fees burned, create deflationary pressure. Developer ecosystem, largest community building on the platform. Staking yield, 3 to 5% annual staking rewards plus potential price appreciation. Long-term thesis, operating system for decentralized internet growth holdings, 15 to 25% of crypto allocation. Layer 1 alternatives, 5 to 10%. Exposure to competing blockchain platforms. Solana, high-performance blockchain with growing ecosystem. Cardano, research-focused platform with academic approach. Avalanche, fast consensus mechanism with subnet architecture. Selection criteria, strong developer activity. Institutional backing, unique technology. DeFi blue chips, 5 to 10%. Established decentralized finance protocols. Compound IAV, lending and borrowing platforms. Uniswap, leading decentralized exchange maker. DAO, decentralized stablecoin issuer. Selection criteria, proven revenue models, strong governance, sustainable tokenomics. Speculative holdings, 5 to 15% of crypto allocation. Emerging opportunities, 3 to 8%. Small positions in high potential projects. AI and data. Projects combining crypto with artificial intelligence. Privacy solutions, privacy-focused cryptocurrencies and protocols. Real-world assets, tokenization of traditional assets. Gaming and NFTs, blockchain-based gaming, and digital ownership portfolio. Allocation examples, conservative crypto retirement, 10% total portfolio in crypto. Bitcoin, 60% of crypto allocation, 6% total portfolio. Ethereum, 30% of crypto allocation, 3% total portfolio. Stablecoins, 10% of crypto allocation, 1% total portfolio. Balanced crypto retirement, 20% total portfolio in crypto. Bitcoin, 50% of crypto allocation, 10% total portfolio. Ethereum, 25% of crypto allocation, 5% total portfolio. Layer 1s, 15% of crypto allocation, 3% total portfolio. DeFi, others, 10% of crypto allocation, 2% total portfolio. Aggressive crypto retirement, 30% total portfolio in crypto. Bitcoin, 40% of crypto allocation, 12% total portfolio. Ethereum, 25% of crypto allocation, 7.5% total portfolio. Growth positions, 35% of crypto allocation, 10.5% total portfolio. Maximizing tax efficiency is crucial for long-term wealth building with cryptocurrency. Crypto IRAs and retirement accounts, self-directed IRA for crypto, using retirement accounts to hold cryptocurrency. Tax benefits, tax-deferred, traditional IRA, or tax-free Roth IRA. Growth contribution limits, $6,500 annually, 2023, $7,500 if over 50 custodian requirements. Specialized custodians like Bitcoin IRA, iTrust Capital asset restrictions. Limited selection compared to regular exchanges. Withdrawal rules, same age and penalty restrictions as traditional IRAs. Solo 401k for crypto, higher contribution limits for self-employed individuals. Contribution limits up to $66,000 annually, 2023. 73 farm $500 if over 50 dollars eligibility, self-employment income or business ownership required. Flexibility, more investment options than traditional 401ks loan options, ability to borrow against account value. Setup requirements, business entity and specialized custodian needed tax optimization strategies, long-term capital gains planning, structuring crypto investments for tax efficiency. Holding period, hold crypto for over 1 year for preferential tax rates. Tax loss harvesting, realize losses to offset gains in same year, FIFO versus LIFO. Choose accounting method that minimizes tax liability. Charitable giving. Donate appreciated crypto to avoid capital gains. Geographic tax optimization. Consider tax-friendly jurisdictions. No state tax states, Florida, Texas, Nevada. Wyoming for state tax savings. International options, Portugal, Singapore, Puerto Rico for eligible individuals. Residency requirements, must establish genuine domicile and residency professional planning. Consult tax professionals for complex strategies, business structure benefits. Using business entities for crypto activities, LLC or corporation, business expense deductions for crypto activities. Retirement plan options, business retirement plans with higher contribution limits, tax elections, S-Corp election for potential self-employment tax savings, professional guidance, complex structures. Requiring expert setup and maintenance. Systematic investing is the foundation of successful long-term wealth building. Retirement-focused DCA strategy extended time. Horizon advantages. Long-term investing changes the DCA equation, volatility smoothing. Longer time frames smooth out short-term volatility. Compound growth, more time for compound returns to accumulate market cycle. Capture, multiple bull-bear cycles increase probability of success. Emotional discipline, long-term focus reduces short-term emotional decisions. Age-based allocation adjustments, modify crypto allocation based on age and time to retirement. Ages 20 or 30, higher crypto allocation, 20-30% for maximum growth potential. Ages 30-40, balanced approach, 15-25% balancing growth and stability. Ages 40-50, conservative allocation, 10-20% as retirement approaches. Ages 50 plus, minimal allocation, 5-15% focusing on capital preservation career phase. Integration. Align crypto investing with career and income phases. Early career, start small but consistent, increase with income growth, peak earnings. Maximum contribution years, consider tax optimization. Pre-retirement, gradual reduction in risk, increase in stable assets. Early retirement, potential income generation through staking and DeFi advanced DCA techniques for retirement. Graduated dollar cost averaging increase, DCA amounts over time. Income growth, increase crypto allocation as salary increases, percentage based. Maintain consistent percentage of income to crypto milestone. Increase allocation at career milestones. Market based adjustments, increase during bear markets. Maintain during bulls, rebalancing strategies. Maintain target allocations through market cycles. Quarterly rebalancing, regular assessment and adjustment of allocations. Threshold rebalancing, rebalance when allocations drift beyond target ranges. Tax loss rebalancing, use rebalancing opportunities for tax optimization, life event. Rebalancing, adjust allocations for major life changes, income replacement planning. Transition from accumulation to income generation. Staking income, 3-8% annual yields from proof of stake networks. DeFi yields, 4-12% annual yields from decentralized finance protocols. Gradual liquidation, systematic withdrawal of principal over time. Hybrid approach, combination of yields and principal withdrawal. Managing risk becomes more critical as you approach and enter retirement. Sequence of returns, risk. The danger of poor returns early in retirement. Definition. Poor investment returns in early retirement years can devastate portfolios. Crypto amplification. High volatility amplifies sequence of returns. Risk mitigation strategies. Maintain cash reserves and flexible withdrawal rates. Timing considerations. Consider market cycles when planning retirement timing. Risk management strategies. Glide path planning. Reduce crypto allocation as retirement approaches. 10 plus years to retirement. Maximum crypto allocation for growth. 5 to 10 years. Begin gradual reduction in crypto allocation, ZITs or 2 and 5 years. Minimal crypto allocation. Focus on stability. In retirement, small allocation for inflation, protection and growth. Emergency fund management. Maintain adequate liquidity for emergencies. Cash reserves. 6 to 12 months expenses in cash, stablecoins. Crypto liquidity, portion of crypto in easily liquidated assets. Staged withdrawal. Multiple years of expenses in low-risk assets. Healthcare reserves. Additional reserves for potential medical expenses, geographic and political risk, diversify across jurisdictions and systems, multi-jurisdictional holdings, assets across different countries and systems, regulatory diversification, avoid concentration in single regulatory environment, exit strategies, plans for regulatory changes or government restrictions, backup plans, alternative locations and systems for asset access, insurance and protection strategies, life insurance, protect family from loss of earning capacity, disability insurance, protect against inability to work and save. Estate planning, proper crypto inheritance and estate planning. Professional advice, regular consultation with financial and legal professionals, converting crypto wealth into sustainable retirement income. Withdrawal rate planning, the 4% rule, adapted for crypto traditional withdrawal rates, adjusted for crypto volatility. Traditional 4% rule, withdraw 4% annually from retirement portfolio. Crypto adjustment, consider 2-3% withdrawal rate due to higher volatility. Flexible withdrawal, adjust withdrawal rates based on market conditions. Income, first, prioritize income generation over principal withdrawal. Market-based withdrawal strategies. Adjust withdrawals based on market conditions. Bull market, higher withdrawal rates when portfolio values are elevated. Bear market, reduce withdrawal rates to preserve principal rebalancing withdrawals, sell overweight assets to maintain target allocations. Tax optimized, coordinate withdrawals with tax planning strategies. Income generation methods, staking and proof of stake yields. Generate income while holding crypto, Ethereum, staking. 3 to 5% annual yields through staking services. Other networks, Cardano, Solana, Cosmos offering 4 to 15% yields. Risk considerations, slashing risk and lockup periods. Tax implications, staking rewards generally taxable as income. DeFi income strategies. Decentralized finance for retirement income. Lending protocols earn interest by lending crypto assets. Liquidity provision earn fees by providing liquidity to exchanges. Yield aggregators, professional management of DeFi yield strategies. Risk management, smart contract risk, impermanent loss, protocol risk, hybrid income. Approaches. Combine multiple income sources, crypto income, 30-50% from staking and DeFi traditional dividends, 30-50% from dividend stocks and bonds, alternative income, 10-20% from real estate, business, or other sources. Flexibility, adjust income sources based on market conditions and opportunities, creating your systematic approach to crypto retirement planning. Implementation, roadmap, phase 1, foundation building, months 1 to 6. Establish the basics of crypto retirement planning. Education, learn crypto fundamentals, security, and tax implications. Account setup, establish secure wallets, exchange accounts, and tracking systems. Initial allocation, start with small, comfortable allocation to crypto. Automation, set up dollar cost averaging and systematic investing. Professional consultation, meet with financial advisor familiar with crypto. Phase 2, portfolio construction, months 6-18. Build comprehensive crypto retirement portfolio. Asset selection, choose appropriate cryptocurrencies based on risk tolerance. Allocation optimization, determine optimal allocation percentages. Tax integration, consider tax advantage accounts and strategies. Risk management, implement security measures and backup procedures. Performance tracking, establish monitoring and evaluation systems. Phase 3, optimization and scaling, years 2+. Refine and optimize crypto retirement strategy. Performance review, regular assessment of portfolio performance and allocation strategy. Refinement, adjust approach based on market conditions and life changes. Advanced strategies, consider more sophisticated approaches as knowledge grows. Professional management, evaluate professional management services if appropriate. Estate planning, integrate crypto holdings into comprehensive estate plans. Monitoring and adjustment framework, regular review schedule. Systematic approach to portfolio management, monthly. Review allocations, rebalancing needs, and contribution amounts. Quarterly, comprehensive performance review and strategy assessment. Annually, major strategy review, tax planning, and goal reassessment. Life events, adjust strategy for major life changes or market conditions. Key performance indicators, metrics to track retirement progress. Portfolio growth, total portfolio value growth over time. Risk-adjusted returns, returns relative to volatility and risk taken. Allocation, drift, how actual allocations compare to target allocations. Income generation, current income generation capacity, financial independence, progress toward retirement savings goals, warning signs and adjustments. When to modify your crypto retirement strategy, excessive volatility, if volatility is affecting sleep or emotional well-being. Regulatory changes, significant regulatory developments affecting crypto life circumstances. Major changes in income, expenses, or time horizon. Market structure, fundamental changes in crypto market dynamics. Crypto retirement planning represents one of the most exciting opportunities to accelerate your path to financial freedom, but it requires systematic thinking and disciplined execution. The key is starting early, staying consistent, and maintaining appropriate risk management. Here's how to begin your crypto retirement journey. First, subscribe to this channel for ongoing crypto retirement planning, education, market analysis, and strategy updates. Second, start by determining your appropriate crypto allocation based on your age, risk tolerance, and time horizon. Begin with a small, comfortable allocation and increase gradually as you gain knowledge and confidence. Finally, share in the comments your current age and retirement goals. Whether you're 25 and planning for early retirement or 45 and looking to accelerate your timeline, let me know your situation. Remember, the best time to start investing for retirement was 20 years ago. The second best time is today. Crypto offers unique opportunities for wealth building, but success requires education, discipline, and long-term thinking.